Hey guys, Dave with Moniology here. Hope everyone is having a great weekend. This is the weekend market review for November 4th and 5th, 2017, where we go through some of the most important charts in the market from a daily, weekly, and monthly perspective to give us a better understanding of what's taking place in the markets, where we've been, where we are, and where we're likely headed. So let's have a look at what's going on this weekend. So starting a look with the 10-year U.S. Treasury yield from a daily perspective, we've had a nice run here since the bottom in the beginning of September, and now it looks like we're starting to pull back, and based on the RSI, which is leading and showing negative divergence, it looks like we're going to break below this 23 level of support. Our hunch, based on looking at the weekly and the monthly charts, which we'll see here, suggests that we're likely going to retest this trend line from the upside around the 21 level, so there's some downside ahead in yields and upside in fixed income. This is the RSI chart on the weekly level here. We likely find support on the 50 RSI, possibly a little bit lower, and it coincides with the retest of this breakout from this bull flag pattern here that happened early in October. This is a very, very bullish pattern, but from a weekly perspective, it's very possible that even in a bullish long-term trend, there could be multiple weeks of decline. And looking at the monthly, we're still struggling to break out of this bullish flag from a monthly perspective. Eventually, we'll break above the 25 level. We think that'll happen this year, but stay tuned. Once this breaks out of the 25 level, from our perspective, that is the ultimate end of this bull market in bonds that we've had for the last 30 years. That likely coincides with a break above 3% on the 10-year Treasury. Till that happens, we're still technically in a bull market in bonds, but we think that this is at the very, very edge of ending. So taking a look at gold daily. So gold has been in the doldrums for the last couple of months here, and gold stocks have really taken it on the chin, and a lot of folks are suggesting the gold kind of bull run that started in January of 16 is coming to an end. We don't agree. We think we're at the very, very early stages of a massive multi-year run in gold that started in 2000, corrected for 5 years from 2011 to 2016, and it has started up again in 2016. So you want to see this 1260 level hold, to be sure, but so long as this holds, expect to see much higher prices later on this year, and so let's take a look at where we are on the weekly, because ultimately that's far more important than the daily. It removes a lot of the noise. We're consolidating perfectly above this breakout here, which coincides with the 1240 to 1260 zone. We are below the middle Bollinger Band, but we are above the 50 EMA and the 200 EMA, and so that is still a very, very important, crucial support. So long as we hold above that, we're going to break back above the 50 on the weekly RSI and likely make a run towards new highs for this year. I will not be surprised, and I say the probabilities are well over 50% that we will hit 1400 at some point this year. So some significant upside ahead in gold, and from our perspective, you want to be looking at precious metals names right now and doing your due diligence for many in those sector. Taking a look at this longer term time frame from all the way from 95, you see here from 01 we had a massive rally all the way to 2011. We rallied from basically a low of 255 all the way to a high of 1923, corrected for 5 years, and now we're breaking above that. We're finding support on that 50 RSI from the upside. Very solid correction, and it's a very healthy one, and if this can hold, this multi-month, we've had a 3-month pullback. If that can hold, this is going to result in a multi-year run to the upside, and we think we are in the very, very early innings of that rally. So stay tuned. High yield daily chart. This is something for market bulls is very concerning. It's starting to really break down the high yield index here, ETF, JNK, and we think that this is going to make a move at the very least towards that 3650 level, possibly much lower. We saw this. Comes as kind of no surprise because it broke down of this bearish wedge and it unsuccessfully retested the upside of this breakdown around the 37 to 37.50 area. And if this continues to break down, this is an area of considerable worry. Another reason why we were suggesting that this is a bearish development is even though as we made kind of new highs here, we had a bearish divergence. We had multiple divergent tops here in RSI, and that's not what you want to see when you're making new highs. Now, taking a look at the monthly, still nothing to write home about. It's our first bearish monthly candle in 6 months, so overall we're still in the bull market in high yield. However, it's starting to give us cause for concern, especially as the MACDs are starting to curl towards zero. So stay tuned. If this continues to break down and this potentially breaks below that 35 level, that might be a sign that we're headed towards a recession. So we'll see. Crude oil, no surprise here. We've called this for a long time. We thought this crude oil would break above 55. It finally has done so with a beautiful candle here on Friday, and so there might be some consolidation above 55, might even push back to retest that 53 level, but ultimately crude oil is going towards 60 and 62, so that you want to be in a lot of energy names right now if you're a swing trader. A lot of great opportunities. One we pointed out was EVEP, down 60% last week, and very, very good opportunities there still exist in crude oil. Crude oil weekly, why we're so bullish? Well, look at the chart. Multi-year top has finally been broken out to the upside. We still have to break above the 200 EMA here, about 57.50. If that breaks, there's going to be a run in crude. And look, RSI is leading. This is what you want to see if you are bullish, because RSI leading means price will almost always follow. Crude oil monthly. Again, inverse head and shoulders is another reason why we were very bullish on the sector. And if this breaks above the 60, expect run towards 70, possibly 80 in the coming months and years ahead. So crude oil, which has been in the doldrums since 2014, is finally breaking above. Another point, very important consideration in our RSI based charting patterns is you want to look at where RSI breaks down and causes price to crash. So the last time this really happened was at this level right here in late 2014, early 2015. Now that's when price really broke down, and now that's the level that served as massive resistance here around the 50 level on the monthly last time around. And we went from 55, we retested that 42 level, found support. Now we created this right shoulder and we broke out above this level. That's crucial. And so while it's very possible, like with gold, we can retest this from the upside here and have a multi-month period of consolidation and correction, ultimately this is a breakout that's going to be epic, and there are just tremendous amount of opportunity in the sector for those who are long and strong. NASDAQ daily, nothing to see here, very bullish, and until proven otherwise, you want to be long NASDAQ. Russell's breaking down, and so on the one hand you might say, well, this might be a bullish flag here, so we'll see. But if this can't hold the 50 EMA at 1472, expect further downside. So what you're seeing here is that the Russell is kind of breaking down. You're seeing high yield is starting to break down, and so is this a leading indicator for possible market correction? We think it very well may be, but NASDAQ and S&P and the Dow, which we don't cover here, are breaking to new highs. So tale of two charts. We think that small caps and high yield are a better barometer of what's actually going on in the U.S. economy than are the S&P and NASDAQ. Looking at the tip to TLT ratio, that's the ratio of inflation, so we're having a bit of a pullback here, but on a weekly time frame, we're still in an inflationary basing pattern, and we're going to break to the upside eventually. The probability is that we are. Inflation suggests that real yields will go higher. Real yields going higher is a very positive development for precious metals and gold. And taking a look at the U.S. dollar, the U.S. dollar had a nice little push higher here on Friday. With a nice candle, and it's no surprise here. Likely we're going to test that 96 level. What often happens is the market makers know where there are significant points of supply and demand, support and resistance. And very often amateurs use the 200 and the 50 EMA as those lines to go short or long. And so the market makers very often rally the price above those points, wash out a lot of the people with stops, and then the trend corrects to the reverses to the other direction. So with the 200 EMA at about 95.60, likely this breaks higher to test that 96 level, which also coincides with previous resistance here and support here and here, and so we think 96 will be the top, and once that's taken, the 200 EMA is taken out, then it reverses back to the downside. On the weekly level, we're just above the 50. We closed above the 50 level on weekly RSI. We might have a little bit of push higher, because once 50 is broken to the upside, that's a very bullish development. And again, that 50 EMA on the weekly coincides with 96, so no surprise that we'll probably meet very, very strong resistance at that point. And looking at the monthly chart, at this point, that 50 level is going to be massive resistance. It was support here. It was where we really broke down considerably from about 100 last time around, and as you look at the support level, 50 served in the past, and now that 50 level is going to serve as resistance, and what it does here will determine the next multi-month run for dollar. Is it going to go higher? It's possible, but the probability from our perspective is further downside. 87.50 is the first target. If that breaks lower, 80 is definitely a consideration. Worst case scenario could go all the way down to 72.50. When we look at the dollar long-term chart, we're talking 20 years, I still think that ultimately we head towards that 120 level, but that's not before we'll retest and see the 80s in the interim. Finally, taking a look at volatility, well, that's being shorted away as well. Just when you thought it's breaking out, well, it did. Well, it's getting shorted away to the downside. So volatility is once again not a factor. And finally, looking at the world chart, world daily, it's starting to diverge, and so that's another area of concern. So now we've seen credit, small caps, and world stocks diverging to the negative side. So that's definitely a development that's worth considering, and we're at this level of RSI, that 70, which is the most powerful resistance, and it coincides with this level here, which is where we broke down in 2007, 2008, where we hit all-time highs. We broke down from that level. Once we broke down from that level, that was the beginning of a market crash. It was also the resistance here, and the last time we broke down was here in 2000. So the last couple times we broke down from these levels, it caused a crash in the markets. Well, now we're retesting that level from the upside. So don't be surprised if that serves as a very, very strong resistance for a move higher. If that breaks, boy, I mean, this is going to be a massive multi-year run, but we think we're at the very, very tail end of this bull run that we've had since 2016, and likely we start retracing possibly as low as 1700 would be my hunch as far as a move down to the downside. Anyways, guys, thank you so much for watching and following and supporting our work. Please do follow us on StockTwits at Moniology Twitter at Moniology. Subscribe and like our videos on YouTube at Moniology. And for those of you who are unaware, we do have a Patreon campaign which allows you to support the work that we do here at Moniology. A $10 donation will help us continue to keep the lights on and make better videos more often. So $10 a month will go a long way towards helping us hit the goal of 500 Patreons, and we appreciate your support and help. So have yourself a great week and good luck trading. Take care.